Okay, I move to the last chapter, which is on dividend decision. I think one of the simplest topic will not take us much time, maybe 4 hours kind of a discussion. Today 2 hours, and tomorrow maybe another 2 hours discussion. I'll first explain what is this decision all about. Now, when a company starts a business, first we learnt is I have to raise money, which is in the form of financing. After I raise money, I have to invest it somewhere, which is investment decision. Raising money was chapter 4, 5, and 6. Investment was chapter 7. And when I invest the money at the end of the year, I want to analyze the performance, whether the company has done well or not done well, which is through ratio analysis, which is your chapter 3. In the ratio analysis, you analyze how is the performance of the company. After that is done, we have to ultimately decide what do I do with the profits earned. That is called dividend decision. Whatever profits an organization has made, something has to be done with that profit. Two things can be done with the profit. One, I keep it in the company and use it for future expansion. Second thing, I can give it to shareholders in the form of dividends. So what is dividend decision is reward which I pay to my equity shareholders, the reward which I pay to my equity shareholders. And what is dividend decision is splitting the profits earned into two parts. What are the two parts? Dividends, retain earnings. Dividends and retain earnings. So in this chapter, we are going to analyze how much should be the dividend payout. How much should be the dividend payout? The objective is to split the total earnings into two parts. Part one is called dividends. Part two is called retained earnings. There are multiple models which are there. Like we did capital structure called relevance model, irrelevance model. What is relevance model? If the capital structure changes, value of the firm will change. Irrelevance model said no impact on value of the firm. Similarly, there are multiple models which will help us in deciding on the dividend per share, and based on that, what is the impact on company value. Some models like again have approach here, which says value of the company will not be impacted whether you pay dividend, don't pay dividend, 100% dividend, 50% dividend, 20% dividend. And there are models which says no, value will get changed, will get impacted in case dividends are paid out. Different approaches we are going to learn. One is Walter's model, Gordon's model, Graham and Dodd model, Lintner's model, approach. 5 models have been given in your material. We are going to discuss each of them. Some questions we will do. Now, in that, approach is an irrelevant model. What is irrelevant model is? It says the value of the share has zero impact because of the dividend decision. Whatever dividend you pay does not really matter. Whether you are paying 10% dividend, 20% dividend, 40% dividend, 80% dividend, it does not matter. First is Walter model. Now, what did Walter model say is whatever dividends I earn or whatever profits we are making, it is split into two parts. What are the two parts? I earn 10 rupees. I split 4 as dividend and 6 as retain earning. 6 as retain earning. So the value of the share is sum of two parts here. What are the two parts? One is what is paid out. Second, what is retained. We learnt earlier K is equal to D1 by P naught plus growth was there. Ignore the growth part. If I interchange this, P naught is equal to D1 by K, which is this part. Dividend by K. Dividend by K. Whatever you are paying out, there is a value for that. There is value for that. Gordon's model added growth on top of it and did calculation. Walter said no growth concept. We'll go with capital appreciation concept. What is capital appreciation concept? So you paid out 4 rupees. Retention is here. 6. Retention is 6. E minus D. That will also be divided by KE only. Both are divided. Here you see divided by KE. Here also you see divided by KE. Formula is plus this plus this. Both KE only denominator. Then why should I split? If both KE only denominator, what is the point of splitting? 4 divided by 10% plus 6 divided by 10%. Or you directly do 10 divided by 10%. So on the retained earnings, I'll multiply something. What is that multiplier? The multiplier is called return of the company as compared to the cost of equity of the company. That is, you retain 6 rupees. Now, what concept says is this 6 can be taken as 7, can be taken as 8, can be taken as 4, can be taken as 3, can be taken as 6 itself in the calculation. How is that going to happen? Along with 6, I'll multiply with sometime 1.5. With 6, I'll multiply with 1.2. With 6, I'll multiply with 1. With 6, I'll multiply with zero point 0.5. With 6, I'll multiply with zero point 0.4. So, two parts to the calculation. First part is D by KE. Second part is retained earnings by KE. If both are D by KE, retained earning by KE, then why should I have the breakup? Why should I have the breakup? That is where they said for the retained earning. For the retained earning, there is a multiplier. What is a multiplier? The multiplier is R by KE. Now, what is this R by KE? R is, let's assume 20%. Company is earning 20%. R is what company is earning. R is return on equity. What company is earning. Return on equity formula we learnt in ratio analysis. If you remember the formula, it was EAES by amount of equity. So R is what the company is earning. KE is what the shareholder wants. Shareholder is wanting 15 and company is earning 20. So we will multiply this number of retained earnings into 20 by 15, which is more than one multiplier. More than one multiplier. If R is 15, KE also 15 into 15 by 15. If R is 10, K is 15 into 10 by 15. Now, why is this multiplier? If company is earning more than what shareholder wants, you will have a multiplier of more than one time. You will have a multiplier of more than one time because I am doing more than what the shareholder is wanting. Shareholder is wanting only 10%. I am saying I'll give 15%. If I can earn more, whatever I retain will have a multiplier of more than one and will ultimately get a higher value. It will ultimately get a higher value. So what concept said is Walter model basically said sum of two parts. What are the two parts? D by KE, which is dividend by cost of equity. This side also E minus D divided by KE. If both are going to be like this, no point in splitting because anyway what you're doing D by KE, then you're doing E minus D. So why to write D separately? If I add them together, D plus E minus D will get cancelled. It's E by KE. Then he said, no, for the retained earning, I'll give a multiplier effect. I'll give a multiplier effect. What is the multiplier effect? It depends on the relationship between R and KE. Depends on the relationship between R and KE. If R is greater than KE, it means I am a very good performing company. Well performing company will have a R greater than KE. It is a sign of a growing company or a company which is able to exceed the expectation. When you exceed expectation, you get a premium valuation. This we learned when I did bond valuation. When I was explaining cost of debt and issue price of a bond, meet expectation, exceed expectation, does not meet expectation. So if R is greater than KE, multiplier is more than 1. R equal to KE, multiplier is exactly 1. And R less than KE, multiplier is less than 1. Multiplier is less than 1. So what is the formula? It can be, see, I can write a common denominator also. I used to write it separately just to explain the formula. But D plus R by KE into E minus D whole divided by KE. Whole divided by KE. Why am I writing separately? I find it easy to explain it. I find it easy to explain this way. D by KE, E minus D by KE. If assume R and K is same, there's no point in doing all this calculation. Directly E by K. It's directly E by K because multiplier will be one time only there. Multiplier is going to be only one time. If multiplier is more than 1, less than 1, splitting makes sense. Otherwise, there's no point in splitting. So, what is the formula? D by KE, R by KE into E minus D divided by KE, or D plus R by KE into E minus D whole divided by KE. Now, what are these terms? D refers to dividend per share. What is dividend per share? Total dividends divided by number of shares. Or you could have come across a term called payout ratio. Payout ratio. If you have a payout ratio, earnings per share into payout ratio. Earnings per share into payout ratio. Or if they give a dividend rate, you multiply with the face value. Dividend rate is multiplied with the face value. Company says 20% dividend, 20% of face value. 20% payout, 20% of earnings per share. 20% of face value, 20% of earnings per share. This is first part. Second, return on equity. Some question will give a different name. Return on retained earnings. Some question will even use the word return on investment. Some question will use the word IRR. whatever name they use. R basically means what the company is earning. It can be called as return on equity, it can be called as IRR, it can be called as return on retained earnings, it can be called as return on investment, it can be called as return on capital employed, it can be called as return on funds employed, whatever the company is earning. In case data is not there, calculation EAES divided by amount of equity. If you divide EAES by number of share, it's called EPS, and equity by number of share, it's called book value per share. All this I've already spent time, so I'm not spending time again on this. So second element I want is R. First element I want is D. Second I want R. Third is EPS, which is self-explanatory. What is EPS? Is earnings per share. EAES divided by number of share, or you use this formula. ROE is equal to EPS by BVPS. BVPS goes to the other side. EPS is equal to ROE into BVPS. ROE into BVPS. Then comes the KE. KE means cost of equity. Multiple names can be there in the question. Investor required return, opportunity cost of capital, rate of capitalization, cost of capital of a 100% equity company. For 100% equity company, cost of capital, cost of equity is same. Equity capitalization rate, multiple different names can be there. So to put it simply, we are going to do two parts: D by KE plus R by KE into E minus D divided by KE. Can I have a common denominator? Yes, go ahead and have a common denominator. Do you want to do it separately? Do it separately. Together, do it together. Doesn't really matter. Concept is very simple. D by KE plus R by KE into E minus D divided by KE. So dividend is the reward paid to equity shareholder at the end of the year or during the year for the capital contribution, for whatever they are contributing. Dividend decision is basically splitting the earnings into dividends, which is called payout, and retained earnings, which is called retention. In this chapter, we'll learn about multiple models on dividend payment and the likely impact of the same on equity valuation. Again, I'm repeating, my chart has to be read along with this only. Chart, you keep it because chart is easy to read, text is little difficult to read. Walter's model. Under this approach, dividend depends on the following item: return on equity, rate of return which the company can earn on retained earnings, cost of equity, rate of return which a shareholder wants from the company. The table I'll explain later. Impact of dividend on valuation: D by KE plus R by KE into E minus D divided by KE. Let's take an example. Current company earns EPS of 20, ROI 10, cost of equity 15. How much is the fair price if you pay out how much? 40%. Payout 40% means from 20 rupees, 8 rupees is dividend, 12 rupees is retained earnings. 40% payout means 40% of the earnings per share. So calculation will be 8 by KE 0.15, R by KE 0.10 by 0.15 into 12 whole divided by 0.15, whole divided by 0.15, 8 by 0.15, 0.10 R by KE into E minus D. E minus D is 12 divided by 0.15, 106.67. Any doubts on this? It's a straightforward simple example. Now I will do a proper problem and then again come back to another concept called optimum payout ratio. I'm yet to discuss that. Let's come to question 1. It's a study mat question. XYZ Limited earns 10 per share. Earns 10 per share is earnings per share is 10 rupees. Capitalization rate. What is the meaning of capitalization rate? Sorry, cost of equity. Cost of equity. Return on investment is R. R and K is given. K is 10, R is 12. Determine the optimum dividend payout ratio and the price of share at that payout. Okay, I have to explain optimum dividend payout ratio then. Determine the optimum dividend payout ratio and the price of share at that point. Now, what is optimum is? Situation, if you are a company who earns more than what a shareholder wants, who earns more than what a shareholder wants R greater than KE. I tell the shareholder that 20 rupees is the earning. You do not have any right on this. Let me keep entire money because I will earn more. I will earn more. If R is greater than KE, I don't want to give any dividend. I don't want to give any dividend. Why? Because I can earn more. You cannot earn. You wanted 10%. I am earning 15%. So I say don't ask any dividends in the current year. I will not give you money. I will not give you money. That is the concept says. What does the concept says? If R is greater than KE, R means what company can earn. KE means what a shareholder wants or what a shareholder can earn. What a shareholder can earn. If I can earn more, I will keep the entire money. If you can earn more, you keep the entire money. If R is greater than KE, zero payout. And if R is less than KE, take full money. Take 100% payout. I give you entire money. I don't want any money. If R is greater than KE, it's a growing company sign. It's a sign of a growing company. A growing company will not pay any dividend, will not pay according to this model, according to the model. And if R is less than KE, it's a declining company because I'm not able to meet the expectation. I am on the verge of a decline. I may get wind up at any point of time later in future. So if R is less than KE, please pay out 100%. And if both are equal, then you keep the money or I keep the money, both are same. So I am the company, you are the shareholder for the entire chapter. Okay, so I am the company, you are the shareholder. What I am saying is I earn more, I will keep the money. You earn more, you keep the money. Both are earning same. Whether you want the money, I'll give you. You don't want the money, I'll keep it. So the concept is very simple. R is greater than KE. R is greater than KE. I don't want to give any dividend. I don't want to give any dividend because I can earn more. R is less than KE. I don't want to keep any money. I don't want to keep any money. I'll give you the entire money. I'll give you the entire money. And if both are equal, it's technically called indifferent. It is technically called indifferent. You want money, take it. You don't want money, don't take it. That is R equal to KE. Clear? Any doubts on this? Now let's come to this question. First, I have to decide the optimum dividend payout ratio. Once I decide the ratio, then I apply the formula. Now write R equal to R equal to how much is the R in this question? 12%. R equal to 12%. KE equal to KE is equal to 10%. K is equal to 10%. It's a growing company or a declining company? R is greater than KE. R is greater than KE. Growing company as R greater than KE. As R greater than KE. Growing company as R greater than KE. Optimum payout ratio is 0%. I am not going to pay any dividend. Optimum payout ratio is 0%. No dividends paid. No dividends paid. But I'll anyway write my full formula. In this scenario, the D by K is of no use because it is 0. But I'll write the full formula. Now write price equal to, write the full formula, price equal to D by KE plus R by KE into E minus D whole divided by KE. D by KE plus R by KE. We will write everything as decimal. Percentage sometimes can lead to mistakes. D by KE, R by KE into E minus D divided by KE. First part is 0. 0 divided by 0.10. 0 divided by 0.10. 0 by 0.10. How much is R? No, 0.12. Please have the habit of writing decimal only. Percentage you can write, I have no problem, but some students make mistake. 0.12 KE. E 10. Okay, dividend 0, denominator is, if you see here, the multiplier effect is 1.2 times. The multiplier effect is 1.2 times. The 10 rupees, you give a extra worth to it. You give a extra worth to it because you are having good earning ability. You are having good earning ability. 0 plus 12 by 0.10, 120 rupees. Clear? Any doubts on this? 0 plus 12 by 0.10. Done? Can you proceed? Following figures are collected from the annual report of XYZ Limited. Net profit, outstanding preference share, number of equity share, return on investment, cost of capital. What should be the payout ratio to keep the share price at 42 by using Walter model, reverse working? I am saying price I give you, you calculate the dividend. Normally you give the dividend, I calculate the price. Here price is given, I have to calculate dividend. So dividend we'll call it as D in the formula and apply. But before I start, I want E. E is earnings per share. So right, earnings per share is equal to, point number A, earnings per share is equal to EAES divided by number of shares. And EAES is PAT minus preference dividend. EAES divided by number of shares. By number of shares. What is the PAT number? How much is the net profit? 30 lakh minus preference dividend. How much the preference dividend? 12 lakh divided by EPS is, earnings per share is 6 rupees. Now we are going to apply the same calculation. Only thing is D is balancing figure for us. D is balancing figure. Any doubts on 6 rupees? All right, is equal to D by KE plus R by KE into E minus D divided by KE. Price equal to D by KE plus R by KE into E minus D divided by KE. In place of price, we will write what? 42. D I don't know. That's what I'm calculating. D I don't know. I'm going to calculate that. What is the KE? 0.16. R point divided by 0.16. E is 6 minus D. 6 minus D. Keep 0.16 as the common denominator and take it to the other side. 0.16 is common for both. So I take 42 into 0.16. Common for both. 42 into 0.16 equal to D 1.25 into 6 minus D. You solve and let me know the number. 42 into 1 into 0.16. Sorry. Okay, and then finally answer the ratio. That is the dividend. Ratio means dividend by earnings. Forty-two into 0.16 is equal to D plus 1.25 into 6 minus D. 42 into 0.16 is 6.72 equal to D plus 7.5 minus 1.25 D. Yeah, D will, if you solve, you will get 3.12. D is 3.12. if dividend is 3.12, price is 42. You change the dividend, price will change. That is called relevance model. Relevance model means there is a change in the value of the company if you keep changing the dividend. D equal to 3.12. D equal to 3.12. Any doubts on this? Finally, payout ratio. Payout ratio is equal to DPS by EPS into 100. Dividend per share by earnings per share into 100. Dividend per share divided by earnings per share into 100. 52%. A 52% payout will ensure that we are able to achieve the required price.